Hello, and welcome to our market check-in. What's up with gold? Well, gold has long been hailed as the ultimate safe haven, as an asset that's supposed to be stable in times of uncertainty. But today, we're going to be taking a closer look at that reputation and see if it's warranted. We'll look at how supply constraints, central bank activity, and investor sentiment may or may not affect the market dynamics of gold. Then, we'll look at gold within the construct of creating a portfolio. Does gold truly offer diversification benefits? Or does it simply sit idle, generating no income and relying solely on price appreciation? Now, that's a stark contrast to stocks that produce earnings, hence there's capital appreciation for those increase in earnings. In an era of rising interest rates and digital assets, we'll question whether gold is a timeless asset, a shiny distraction, or perhaps a bit of both. But before we continue, we ask you to subscribe to our channel, Retire with Style, and like this video to make sure you receive fresh new market check-ins, where we will break down popular investment and financial planning concepts. Why all the talk about gold lately? If you look at the recent returns from gold, it's easy to see why it's called investors' attention. In this chart, we present the spot price of an ounce of gold in US dollars since 1975, after gold futures contract began trading. As you can see, there is a noticeable spike in the price over the last few years. Since October of 2022, 1 ounce of gold was worth $1,655. But by the end of October of 2025, it was valued at about $4,023. That's a hefty return of 143% in just 3 years. Now, you may be asking yourself, why has the price of gold gone up? It's simple. The cheeky answer is that the price of gold increases when demand exceeds supply. But what can we say about the factors driving that demand and its supply? Let's first start with supply. Supply for gold is inelastic. What does that mean? Well, when supply is elastic, it will rise with prices to meet heightened demand. You can make more pretty easily. However, the supply of gold is inelastic. It doesn't function in that way. Gold is a finite resource and time-consuming to mine. So, the increase in the gold supply remains relatively small relative to the fluctuations in its price. For example, in 2024, global gold production represented an increase of less than 2% of its total supply. As a result, the price of gold tends to be highly sensitive to changes in demand. On the demand side, researchers have identified a few key effects that may have contributed to higher demand in past years. First off, in 2004, the world's first ETF backed by physical gold was launched. Before then, buying gold typically meant purchasing and storing it yourself. Gold ETFs appear to have provided a convenient outlet for this pent-up demand for gold. Another potential contributor to gold demand has been from central banks. According to the International Monetary Fund, the IMF, central banks have added more than 2,000 metric tons of gold to reserve assets since 2017. This represents more than 1% of the world's in-circulation gold supply. While some have suggested that non-U.S. economies have been de-dollarizing, recent Fed research sheds some doubt on this theory. The Fed study found that while 62 countries have increased their gold reserves between 2008 and 2023, this increase is more of an and rather than a but. Only a few of them have actually clearly reduced the US dollar reserves while also increasing gold reserves. The countries specifically I'm referring to here are China, Russia, and Turkey. For about half of the remaining countries, increases in gold weren't found to come at the expense of US dollar reserves. In fact, the US dollar remains the global reserve currency, accounting for approximately 60% of all reserves, and it's also still China's largest currency. What about investors who are chasing hot returns driven by fear of missing out, the dreaded FOMO, or fearful investors buying gold as a perceived safe haven? Well, both could also play some role in this recent demand. What might we expect from gold returns in the future? Well, no one knows for sure, but the work of researchers Urban Harvey again provide useful context to examine this, both from a historical and theoretical perspective. They conclude in their research that over the last 2,500 years, yes, you heard correctly, 2,500 years, gold has roughly maintained its value after accounting for inflation. They concluded that the wages paid, pretty clever actually, they concluded that the wages paid in gold to ancient Roman military officers are about the same as the amount of gold U.S. Army captains could purchase with their full annual salaries today. Generals may be a different story, but so it goes. This suggests that over the very long term, gold has generated a zero real return. And by real return, I mean after inflation. In the short term, however, gold is volatile and at times yield positive returns, real returns, while at other times, negative real returns. This is consistent with what you would expect from an asset whose prices fluctuate solely in response to changes in supply and demand. Their findings also imply another important takeaway, and that is, if the expected real return of gold is zero, it is reasonable to expect that returns for gold going forward will be lower, especially after a period during which gold prices have risen much faster than inflation. Remember, over the last 3 years, they have gone up 143%. So what might we expect from gold returns in the future? Well, gold has been far from immune to drawdowns. In fact, since 1970, gold has been positive in just 60% of calendar years, while the S&P index has been positive in 80% of the years. Think about that for a second. Investors hoping for a safe haven from stocks may not find it with gold. So, should gold have a role in diversified investment portfolios? Some say yes, some say no. Warren Buffett has long been in the no camp, describing gold as an unproductive asset because it doesn't create anything of value or generate income. He has a famous essay where he does a hypothetical of putting all the gold in the world in Yankee Stadium and coming back 20 years later and finding out that gold hasn't grown or anything, it's still there, as opposed to earnings from companies. He compares buying gold and hoping someone will pay more for it later more to gambling rather than investing. And I also subscribe to this based on my reading of the literature. However, that's just one person's opinion. So let's look at the data for more objective context. Here in Figure 4, we present an analysis based on annual returns from 1928 to 2024 for gold and other common asset classes in investors' portfolios, including stocks and bonds. And I find several key takeaways here. First one being that gold actually has not produced a zero real return in at least the last 96 years. However, its 6.75 nominal average return amounts to less than 4% after accounting for inflation. Remember, you remove inflation from the mix and it's really only returned 4%. And that's less than half of the real return for US stocks, but with higher volatility. And higher volatility is a measure of the variance of those returns, the variability, better said, of those returns being positive or negative. In fact, BBB rated corporate bonds compared to gold have provided a slightly higher average return with less than half the volatility. So here, my takeaway is that you don't need to invest in everything. You know, that would be challenging in and of itself, but you don't need to invest in everything, but rather in a collective of asset classes that complement each other very efficiently for the greater good of the portfolio. Gold has exhibited near zero correlation to U.S. stocks, but so have treasuries over the long term. When paired with stocks, bonds have historically tended to help cushion overall portfolio results when equity markets perform poorly and with significantly lower volatility. And that lower volatility is the name of the game when you're constructing a portfolio, especially for retirement. As an inflation hedge, the effectiveness of gold is also questionable. There is some positive correlation, but gold's much higher volatility compared to inflation makes it an imperfect hedge at best. It's hard to hedge. If something is moving with this type of volatility, it's hard to hedge against that with something that moves like this. The noise, the statistical noise is just too much to try to disentangle that. So what's the goal? There may be reasonable uses for gold in an investor portfolio. However, there might be potentially better options to help achieve an investor's goals. And finding out that goal is really integral to seeing what role gold may play in your portfolio. From a portfolio in which you're taking out sustainable withdrawal rates, really the name of the game is to try to get a consistent return as possible with minimal volatility. And only after that is clear can you really determine what role, if any, gold has in there. Simply buying an asset because others have recently had success with it is never advisable. In our view, that's more akin to gambling and not investing. Since 1970, gold has experienced extreme price swings when compared with changes in the rate of inflation. An effective inflation hedging tool should have return volatility that is more on par with changes in consumer prices, hence inflation. If your goal is to hedge against inflation using Treasury inflation protected securities, the acronym for that is usually referred to as TIPS, whose values adjust with inflation, may be a more reliable approach. It's reasonable to be concerned about rising prices, but investors who want to hedge against inflation, especially during their retirement years, may find gold to be the wrong tool for the job. We hope you found this helpful, and please subscribe and hit the like button so we know to keep this series going. If you agree or disagree, let us know in the comments section below. Thank you and have a great day.